Good morning, everyone. It's worth just mentioning we are living in interesting times. I noticed this morning, of course, with the issues with the virus, some people were shaking hands, some people were doing the elbow bit. Nobody resorted to the Jurgen Klopp jumping up with the chest and bouncing off each other. I actually favour what Prince Charles has done recently, taken advantage of living in a multicultural society and has picked up on the Hindu approach of that. And I actually think that's far more appropriate these days and all that. So I expect everybody to adopt that. A few of us are going on to an event later on today, and I expect those people, I know who you are, to be adopting that approach. But we are in interesting times, of course, aside from the issues with the virus. We've got Brexit and all the issues that go with that. We've had quite a historic general election with the Tories going heavily into Labour areas. And with the budget itself, a lot of policies that were announced, I think some of the Labour politicians would be quite envious of what Rishi Sunak has proposed. Also in interesting times, I just can't get used to the idea of a young Chancellor. He's nearly around the age of my son. And I don't know where I've transcended from being a young man to being the old man, and people now making jokes about my age. We have within the Asian community this respectful approach that if you ever see somebody and you don't even know them, you'll refer to them as brother. So I've always got used to that. Nobody takes any kind of offence about it. We had a takeaway delivery guy came along and a couple of years ago, and he called me uncle. So we stopped using that takeaway. Right, okay, on to the serious business. What we'll do is actually cover a number of relatively minor changes, but then focus on the main change to deal with entrepreneur relief that was announced and John touched upon. So, capital allowances. Most of you will be aware that the allowance is now at £1 million on plant and machinery. When it was announced originally, the move up from £200,000 to £1 million, it was intended to be for a temporary period, ending at the end of December this year. We were hoping that that period would be extended. No such announcement. So, as far as we're aware, then from 1st of January, it'll revert back to £200,000. So, if you are looking at capital expenditure, perhaps accelerate it if you can. Don't necessarily go beyond 1st of January. Some minor issues on capital allowances as well. There's been 100% allowances given over the years in relation to energy efficient technologies. You would have thought that that would have been continued, but that's coming to an end from April 2020. Instead, the Chancellor has favoured extending the capital allowances in relation to enterprise zones. 100% allowances on plant and machinery in enterprise zone areas. Structures and buildings allowance. This was introduced a couple of years ago, where at a rate of 2% it was at that point, with the intention, therefore, that over a period of 50 years, the construction costs can be relieved for tax. That rate of allowance has now been improved to 3%. So it stays at this flat rate. It'll be worked out on the original construction expenditure, and it actually just flows through from one owner of the property to the next. So that over now 33 years of life, you'll get the full relief for the construction expenditure. It doesn't apply, though, to the purchase of land element of the property or any planning permission costs. But it can apply not just to trading properties, but also investment properties. So it's worth looking at. Not many people are particularly familiar with the scheme, but it is there for the qualifying properties. Research and development, we've talked, I know on a number of occasions in these presentations, about how the government are keen to continue to get people to identify research and development, commit more expenditure to it, and get very favourable tax reliefs with it. So there are two types of scheme, one for small and medium-sized enterprises, and a different scheme for larger companies. For every qualifying pound spent by a smaller company on research and development, you're effectively getting 43.7% relief on it. So it certainly pays to work out whether you can qualify. Even loss-making companies can benefit in terms of getting an actual tax refund, which again works out to an effective rate of 33%. Certain changes that we're going to make to restrict certain loss relief claims, they've been deferred, so that's welcome. But the main change that the Chancellor announced was in relation to large companies who get a credit equivalent to 13% now. But in actual tax relief terms, it works out to being something near 30%. But it's the government have identified that this is where Britain can take the lead, and they're actually pushing very hard to get companies involved with R&D, and they've set a target of 2.4% of GDP by 2027. A couple of smallish issues. Those of you involved with non-UK companies that invest in UK properties, the tax rules there is that the net rental profits that they make are actually charged to income tax at 20%. Those rules are changing from April. They'll be transitioning into the corporation tax rules, which basically won't make much difference, but there will be some companies that may get caught out a little bit. So if you have any clients perhaps that are involved with those type of companies, please do have a word. A lot of you will be aware of the Enterprise Management Incentive Scheme. It's a scheme for certain companies to offer share options to key employees and for them to be able to exercise those options at a favourable price, sell them at a profit when there's a sale of the company perhaps, and realise the profit possibly at rates as low as 10%. It's been taken up quite a lot with quite a lot of our clients, but there are only certain types of companies that qualify. The revenue are looking to extend the qualification categories, so we may see a bit more coming through regarding EMI. Stamp duty land tax, there's been a further disincentive, if you like, for non-UK companies and non-UK individuals investing in UK property. And so there's now an extra 2% surcharge on the stamp duty for such properties. Bearing in mind, currently, for properties over at £1.5 million, there's a 15% stamp duty charge. It will be 17% for non-UK resident companies and individuals. Right, so let's focus on the main issue that was highlighted from a tax point of view, at least in the budget. John touched upon it. So most of you will be familiar with entrepreneurs' relief for qualifying companies and the shareholders being able to get a 10% tax rate. So it works on the basis of your lifetime gains on qualifying company shares being charged to tax at 10%. Previously, the lifetime gains, £10 million, now reduced to £1 million from budget day. One of the things that we have also noted is that where deals have already been done, but where the consideration hasn't been fully paid out in cash, so therefore some of it is deferred in the form of, usually in the form of loan notes or preference shares to be paid out over time. Those cases, the revenue have identified that as those loan notes are redeemed or the preference shares are redeemed, they'll be caught under the new rules. So if you've already had, say, £1 million out on your sale in cash in the last year, let's say, any future redemption will all be charged to tax at 20% rather than 10%. Let's look at a brief example then, just to highlight that. Mr. Jones sells his company in December 19, so bear in mind this is well before any anticipated change to the rules. His company's worth £10 million. £1 million has been paid out in December, but the remaining £9 million was going to be paid out over a period of time. As we always do, we write to the revenue, get clearance from them to accept that if we don't necessarily have to pay the tax on the £9 million until those amounts are actually received. However, we also have the option to make an election to actually say, well, despite the fact that the revenue have given us clearance, we'd rather pay on the £10 million as though it all been received. And why would we do that? Because we would have certainty at the 10% tax rate. So, but the rules that came in on budget day actually are targeting that ability to make that election. If you're making that election after budget day, it's not effective in terms of achieving certainty of a 10% rate. So I'm afraid in Mr. Jones' case, £9 million will probably end up being taxed at 20%. So there's no point in making that election. Instead, just pay tax as he redeems those loan notes. So the £1 million limit that we've got at the moment is actually back to where we were in 2008 when Alistair Darling brought the entrepreneur relief rules in. But in that time, the rules have changed and there are quite a lot of pitfalls. So we just need to be careful to make sure then that we're not tripping up just because there's less value to entrepreneur relief now than there was previously, that people don't get too complacent about it. So key conditions we've got to keep on satisfying: that the shareholder owns at least 5% of the share capital and voting rights, is entitled to 5% of the profits available for distribution and assets on the winding up, and the shares must be in a trading company or a trading group. The individual needs to be employed in some capacity, might even be part-time or even unpaid, but you can be an officer of the company, unpaid, but still qualify. And those rules need to be satisfied for the 2 years leading up to the disposal. So what will that actually mean now? With the changes announced on budget day, it may mean that we've got to be a little bit more willing to perhaps spread the shareholdings in companies between family members, because they'll each have the £1 million of allowance available to them. However, those people who've got shares that are worth a lot more than just £1 million, they may perhaps revert to their behaviour that was applied before. Steve touched upon it, with people doing various schemes to keep the tax bill down. I can only reiterate what Steve said there. Really, those kind of schemes are a thing of the past, or should be a thing of the past. The revenue have got a lot more powers and have been very successful in challenging and cancelling out any tax advantages of those schemes. Some people, though, I've had clients over the years who've actually previously, when the tax rates were higher, were prepared to go non-resident and sell their shares in the company after they become non-resident. And I'd be saying to them, well, what's the point? If all that you're saving is 10% tax in going non-resident, it's not worthwhile. Now that if a large part of their tax is 20%, some of them might actually start leaning a little bit more towards that. We'll see how that changes people's behaviour. If you have got a tax bill at 20%, you can actually still defer paying that tax if you reinvest the money into qualifying investments. So some of you will be familiar with the Enterprise Investment Scheme, which is really investing in other trading companies, which are, of course, have a risk element to it. But if you do make those investments, you can delay the tax that you would have triggered on your own share disposal until you sell the shares in the company that you've invested through the EIS scheme. There's also been, over recent years, a bit more popularity with certain companies or certain shareholders of companies selling their shares to an employee share ownership trust. So the nearest thing you perhaps can relate to that is John Lewis is employee controlled. You don't need to be John Lewis size, but certain size of companies it's particularly suitable for, where perhaps the owner of the business decides, actually, I'd rather not sell to a third party. I want to keep the employees in there. I like the culture of the business. I don't want it all changed with new purchases. I'll sell to a trust where the trust owns more than half of the company. Selling your shares to that trust, if you satisfy the conditions, you can do it without any capital gains tax. So it may be appropriate for certain companies. And sometimes, although it looks a little bit counterintuitive, it's sometimes worth not getting too hung up about entrepreneur relief. Perhaps look at whether your circumstances may be better where you're not relying on entrepreneur relief. And we can perhaps just look at a brief example here. So Mr. and Mrs. Brown here, they have a trading company which has a holding company in which they hold the shares. So they're looking to sell their company, and if I just go back there are special rules which allow a holding company to sell a trading company without any immediate tax. So that should be possible. So then the cash comes into the holding company. Perhaps it may then be worthwhile just investing that money, whether it's in property, whether it's in quoted investments, whatever it may be. And for Mr. and Mrs. Brown to actually draw dividends each year, they can take out, let's say, £80,000 a year between them within their basic rate tax bands, and just use their holding company as an investment company for the longer term. So they're not actually ever going to take advantage of entrepreneur relief. What they'll do is just keep that company going for themselves for as long as they want. If they keep the shares in that holding company until the date of death, there's no capital gains tax on assets held at death. They may have some inheritance tax to pay, but if we know that that's the strategy they're going to take, we can do some inheritance tax planning during their lifetime, whether it's to involve other family members or trusts. So in this situation, we're not going to really get too hung up about entrepreneur relief. Different example, Mr. and Mrs. White, they've had a successful company, a trading company continues that way. The surplus cash that they've built up, they've put into the holding company, and that company has bought investment properties. They don't have any plan to sell. And if they do that, then they've got on death, because it's still a trading company, trading group, no capital gains tax, and probably no inheritance tax because trading companies are exempt from inheritance tax. So that might be a strategy just worth working to. Mr. Black here, who just owns shares directly in his trading company, fine, we don't know necessarily what his longer term plans are, but as many of you will have heard in previous presentations, I've said about the need perhaps to have a holding company so you can protect value in the holding company, whether it's putting a property up there, putting surplus cash up in there. Mr. Black perhaps should do that, but in doing so, what we actually achieve as an incidental benefit is that the shares that the holding company has, then in the trading company, is treated for tax as though the holding company's paid a market value for those shares. So if later on he decides to sell the trading company, it may be that it again can be done with little or no tax, and then we can go back into the same plan whereby perhaps Mr. Black uses his holding company as an investment company. So that's covered quite a few initial thoughts regarding entrepreneur relief. It's still going to be an important relief for many businesses, but it may be that the emphasis is changing for some people, whereby they may take a slightly different approach for the longer term. So partly linked to the higher rate of tax to do with entrepreneur relief only being available on the first £1 million, we may perhaps look at some of the shares in companies being held in family trusts. We've tended to resist doing that in certain cases because shares held in a family trust wouldn't have got entrepreneur relief. Well, if we're not going to get any because the first £1 million has already been used up, then we may as well look at perhaps in lifetime putting shares into a family trust, knowing that once someone survives 7 years from putting those shares in, no inheritance tax on those shares, but also the capital gains tax is no worse than it would have been had it stayed in people's own individual names. If you have shares in an investment company, we've got far less favourable tax rules there, but we should, for inheritance tax, perhaps look to at least stop the problem getting any worse. And we often look at creating a new class of share which draws a line on today's value in the investment company and says that all future growth in value of the company is in those other shares which you might wish to give to other family members or a trust. The general point, please make sure people got wills in place and keep them under review, and also, if necessary, have some lasting powers of attorney in place. But if anything, it's telling us, the tax landscape keeps changing. All we can do is keep planning, not for the short term, really look at the medium and longer term plans about sale or succession. And coming up, the Chancellor mentioned on a couple of occasions about an autumn budget. I do expect that that will bring in certain rules which may wish to raise taxes, and pointed out to me just before I stood up here that Rishi Sunak's an anagram of his name is I shun risk, which I suppose, based on his performance on Wednesday, he's taken a risk in terms of borrowing heavily to fund the spending plan. But I do think reality may have to come into play whereby some taxes will need to rise in the next year or so. Steve mentioned about revenue focus on tax avoidance and evasion. They continue to arm themselves with more powers. So we've got to be very careful about how you've got some people who are reckless, if you like, in terms of their approach to tax planning. It needs to have a commercial basis to it, fit into a longer term plan. Then we've got far more reasons to be able to defend any revenue challenge. I do suspect that there will be changes to inheritance tax over the next year or two. There seems to be a sentiment that it doesn't really achieve what people want, and it can be quite unfair. Whether that means that there's a wealth tax instead to replace inheritance tax, we'll have to wait and see. The message, as ever, whenever I speak here, is that to plan ahead. Obviously, as a country, we're going through a difficult time now. If we think back to the financial crisis in 2008, one thing that came out loud and clear was the need for us to help each other as best we can. So closer liaison, we're here to help you, not just financially, but businesses will be going through a difficult time. And if we can help, please do give us a call. Pass you back to John. Thank you.